There are many ways to manage risk in commodity markets. Those involved in buying and selling grain understand the potential price risk when marketing their commodities. However, there are various tools that producers can use to manage those price risks. In this video, we're going to discuss hedging, what it is, and why it can be a useful tool. Hedging is a risk management strategy that involves taking the opposite position in the market until a commodity is sold to protect profits or limit losses. A farmer who sells his or her grain is considered to be long in the cash market and wants to get the highest possible price. When they want to hedge, they can take on a market position with a broker using either futures or options that will make money when the market moves opposite of their cash position. Therefore, they can enter a hedge by selling their grain for cash and re-owning with futures or call options, buying put options, selling futures, or combining any of those strategies. Most farmers hedge against downside risk by taking a bearish futures position or options position with a commodity broker. As an example, let's say Joe Smith grows 100,000 bushels of corn. In July, he sees that corn is at $5 a bushel. Since corn prices typically fall between July and September, Joe wants to lock in his selling price on some of his bushels. In order to secure that price for about 25% of his total corn crop, he needs to hedge those bushels. And since 5,000 bushels of corn make up one futures contract, he would need to call his broker to sell 5 futures contracts to be hedged on 25% of his total expected corn crop at $5 a bushel. Between the time that Joe Smith places his hedge and when he wants to deliver his grain, corn futures fall 50 cents. The September futures contract goes from $5 a bushel in July to $4.50 in September. Assuming that basis is left equal under September futures prices, Joe Smith's cash price fell from $5 a bushel to $4.50. In the cash market, Joe Smith lost 50 cents a bushel. However, because of his short futures position, he gained 50 cents in the futures market. That means the 25,000 bushels of corn he hedged is still worth $5. The same could be said if the market moves in the other direction. Assume that instead of falling 50 cents, prices rise 50 cents. That means Joe's short position lost 50 cents a bushel. However, his cash position still gained the lost value, leaving his net selling price at $5 a bushel. Therefore, the risk from the hedge came in Joe's margin account, which resulted in a cash loss versus a potential value gain on his unpriced bushels. Like all things, entering a futures position is not free. It involves initial capital requirements and brokerage fees. Ultimately, it involves creating a price floor for your grain to build on for the rest of the marketing year. A speculator willing to assume your downside risk lets you focus on the potential upside. There are multiple ways a farmer could hedge their grain that involves more than just buying and selling futures contracts. Farmers can also enter hedge to arrive contracts, or HTAs, which allow producers to lock in futures price with an elevator, leaving the basis to be set at a later date. In that case, the elevator will establish a hedge in the futures market on your behalf in the exchange for delivery at a set time. Keep in mind that those contracts still come with a fee. Options are another way producers can hedge their commodities. Producers not wanting to sell their grain can purchase a put option to hedge. Likewise, an end user like a cattle feeder or an ethanol plant worried about grain prices rising can buy a call option to hedge their future grain purchases. More complex option strategies also can be used. But when you put on a commodity hedge with a futures broker, you are playing the market in a way that puts cash into your brokerage account when the market falls, therefore offsetting the paper losses you are taking on unsold bushels. If you have any specific questions about hedging, Trader PhD subscribers can call to get in touch with our consultant to explore options that best suit your operation. Thanks for watching. I'm Dawson Schmidt, and this has been Trader PhD.